it is difficult to see how piling into Netflix now as a severely beaten down stock makes sense, because though it is very badly beaten down, it was falling from a height that was unjustifiable on any economic grounds.
On this episode of Early Bird, John Engel, president of Almington Capital Merchant Bankers. John joins the podcast today to talk about the streaming wars in the stock market with Netflix and other competitors, including a look at the recent earnings from Netflix. If you're an investor looking to stay on top of the latest market trends, then you're listening to the right podcast. This is Early Bird, and I'm your host, Stephen Lerner. Before we get to today's discussion, let me tell you how you can save time and beat the market through Early Bird, a free daily email newsletter featuring commentary about the latest trends in stocks, cryptocurrency, and equity crowdfunding. Early Bird is designed to help individual and non-professional investors stay on top of all of the critical investing trends. The newsletter is 100% free and is sent to your email box each weekday morning. Subscribe to Early Bird for free at www.earlybird.email. Once again, that's earlybird.email. And now, today's discussion. All right, John, thank you for coming today to the Early Bird podcast. Welcome, John. How are you doing?
I'm doing great. Thanks for having me on.
No problem. I'm really excited. Today we're going to be talking about Netflix stock and really all the other stocks in this streaming space and what it means for retail investors. Before we do that, though, let's talk a little bit about your background, John. If you could, 30 seconds, quick biography, tell everybody quickly about your background.
Sure. My name is John Engel. I am president of Almington Capital Merchant Bankers. We are a small investment firm based in Illinois. My background is in startup financing and consulting, as well as in venture capital and public equities investments. And our firm specializes in sort of special situations and event-driven investing across a wide universe of different industries.
Nice. So you're well diverse. That's great. Have lots of different opportunities for your firm. So today we're talking about Netflix. Just a few weeks ago, Netflix, the streaming giant, posted its earnings, and the earnings did not go so well for the company. The company lost 200,000 subscribers. It marked the first time in over 10 years that Netflix actually lost subscribers in a quarter. And the company expects to lose even more subscribers in the upcoming quarter, the one that we're currently in. John, what do you make of Netflix post-earnings?
Well, as is often the case with companies that are driven very heavily by a narrative expectation of essentially infinite growth, when that growth hits a wall, even a moderate one, it can completely transform the way people look at that stock. Netflix is a perfect example of that, and doubly so, because not only is it a highly narrative-driven stock in its own right, it is also, until very recently, in terms of public mind share and investor mind share, been treated as if it is the streaming industry, and that it's almost a proxy for streaming as a whole. As competitors have emerged, and now as Netflix's growth has stalled fundamentally, that view has been radically reassessed and caused the pretty tremendous drop in the stock since earnings.
Yeah, I think you're right. The streaming industry has changed. Netflix, as we said, bad earnings for Netflix. What do you make of the earnings? They lost subscribers. They blamed everything from competition. They blamed the war in Europe. They blamed password sharing. What do you make of the actual earnings from the company?
Netflix, as has been the case for quite a while, had very healthy revenue. Their cost of revenue, however, is growing faster than their actual than their revenue is growing, which is a function in large part of the fact that Netflix, unlike a lot of other streaming platforms, is reliant on licensing the content of other IP holders rather than resting on their own. In terms of the actual earnings, there wasn't anything catastrophic on the financial side so far. but Netflix has never made as much money as its valuation implied, because the expectation has always been that as Netflix eventually sort of becomes the streaming universe, it would have enormous pricing power that would eventually allow it to raise prices and sort of move from very, very thin margins and like frequently negative overall like free cash flow when you're talking about reinvestment in content themselves. You end up with a lot of problems when content becomes more expensive. You can't grow your top line, and people are going elsewhere for like their content. So Netflix, they lost 200,000 in the first quarter. That is not the worst outcome on its own. They lost more people from leaving Russia than the 200,000 net loss was. So they would have still had a small net gain if they hadn't basically shut off service in Russia. But that won't be an excuse in the next quarter. And they know that, and they've already flagged that they're going to lose, an order of magnitude more, like in the million plus range of subscribers in the next quarter, which is obviously not great for a company that is valued as if it will grow ad infinitum.
Yeah, it's not a good time for Netflix. It sounds like you're pretty bullish on the stock, right?
I would call myself on the sidelines right now. It's fallen a lot, and a lot. I'd say that what we did, what I say most people would wisely do in the near term would be like to cover or to watch on the sidelines, or at least reduce a short position if they have one, because it's fallen a lot. It probably has more to lose over the longer run as people come to terms more and more with the fact that Netflix is one of many competitors in a fiercely competitive and ruinously difficult market to be in terms of just media, and that they have the fundamental disadvantage of not having anything other than streaming, and their IP the IP they actually own is very limited.
So I agree with you totally. I and I was being sarcastic before. I don't agree. I'm not bullish on this company. I do not own it, but I just want to play devil's advocate a little bit here. Let's just hypothetically assume that I was bullish on the company. The stock is down, 70%, more than 70% since peaking several months ago. So it's a good buy the dip opportunity. It's a company where they're going to look at other revenue streams, including advertising revenue in the future. And then in the immediate future, they've got the latest season of Stranger Things coming out, as well as other series. Is that not a good opportunity for investors as you see it, or am I missing something?
Well, I would say that there is, based on just sort of the trading behavior around Netflix, is that significant new content dropping can be a tailwind, like a positive tailwind. The fact that it is beaten down, which is why I say like standing on the sidelines is probably a smart move if you were shorting it until recently, simply because there will be traders who may think and like to create sufficient number of traders to create sufficient momentum to pop it up a little bit. But looking at the sort of broader trend, it is difficult to see how piling into Netflix now as a severely beaten down stock makes sense, because though it is very badly beaten down, it was falling from a height that was unjustifiable on any like economic grounds. I mean, even now, Netflix's market cap, in the $80 billion range this week, that is just a little less than half right now of what Disney's is. And so if you compare those two companies, Disney is rapidly gaining on Netflix in terms of will probably have as many streaming customers as Netflix does this year, and streaming is just one of an omni-channel media empire that Disney has. Yes. So it has television, it has films, it has merchandise that is just incredible business. It has theme parks. It has all these elements that are monetizable, but it also owns just an astonishing amount of monetizable IP. Like Stranger Things is actually a very good example of one of Netflix's very few potentially durable pieces of IP, but even it, if you think about it, is actually basically just derivative of like 1980s horror nostalgia and sort of teen movie nostalgia.
Yeah.
Like I'm not trying to trash talk Stranger Things. I'm saying that it is something that is built on other IP, like and memories of other IP, is difficult to make into sort of the flagship explanation for why you should believe that their IP portfolio will be able to sustain them through this, because it just costs an incredible amount of money and a lot of time to build a Disney level, or even like Viacom or CBS, like has all these really great IP catalogs. I think few in the world today.
So, John, I do want to talk about these competitors in a second, but I think it's very interesting. Hopefully, I don't think Netflix can wait any longer until the next Squid Games comes out. They might need that boost as soon as possible. But I kind of want to take a step back a little bit quickly and just look at this higher level topic. You've said to me earlier about how retail investors have considerable exposure to the company, and you wanted to highlight the dangers of narrative-driven stocks and rapidly evolving industries. Can you explain what you mean by that?
Right, absolutely. So as is what can frequently happen when you have a new technology and disruptive new player enter a market, is that people begin to associate the new technology or the new business modality with that company. So we've seen this a lot in recent years. You see like Netflix being just one example in this case, becoming essentially representative of streaming. That people who believe that streaming was the future invested in Netflix because Netflix was streaming. We saw this play out in a much shorter time frame with things like Virgin Galactic, which was seen as the first real, essentially pure play space flight stock that people were investing in it because it was the one thing they could invest in that was part of the space economy. That obviously corrected rapidly. You see it with like electric vehicles, where Tesla for many years and even now is valued at a way that almost implies that it is not only the electric vehicle industry, but sort of the future dominant player in automotives. So you have this narrative that makes it very easy to think about the one player that's growing rapidly as the inevitable only player in the industry. But unlike sort of networking platforms, such as search in the case of Google, or various kinds of like social networks that have emerged there, or Amazon with distribution, there isn't a natural monopoly here that can be defended. And media is actually one of the ones that is least defensible, because creation and dissemination of monetizable intellectual property is a much longer sort of development and sales cycle, but it's also just fiercely competitive, and the barriers to entry are extremely low.
Streaming is a competitive market. When we return, we'll hear from John about different streaming stocks and his advice for retail investors. But first, let me tell you where you can become a more informed investor through Early Bird, a free daily email newsletter. Early Bird has commentary on the latest events and trends in stocks, cryptocurrency, and crowdfunding. With Early Bird's daily weekday email, investors can quickly stay on top of the trends and beat the market. Subscribe to Early Bird for free at www.earlybird.email. Once again, that's earlybird.email. And now, back to today's discussion. So, John, today we're talking about Netflix and the horrible earnings it just had, but we're also taking a look at the streaming industry as a whole and some of the big up-and-coming competitors. You mentioned one already, Disney, and how it has this really nice diversified portfolio of beyond just streaming. It has the theme parks and other properties, and it's able to get revenue from different sources. What other companies that are involved in streaming that you also like?
Like is a difficult term in the sense that I believe that there's value in some of these platforms, but frequently there's a difference between having a good product and a well-priced business from an investment standpoint.
Got it.
And as with much of streaming media, we've seen like Disney had, a fairly parabolic rise in the last couple of years as people began to reprice it as a streaming company. But that repricing, it can be great when you're riding it up, but when people realize that the economics will be more similar to what was already known, the repricing tends to go back towards that direction. So in terms of what companies like I like amongst streaming players, what platforms I think are interesting, I think Viacom has had some issues, to say the least.
Yes, but it's got they got a lot of good properties. Viacom.
It is its whole issues have made it a bit untouchable from my perspective even now. But the only real streaming players that I think are interesting as part of a bigger company are probably Disney would be at the top, principally because they are spending a ton of money on building their streaming channel. They are also packaging it with sports in terms of ESPN Plus, which is an important thing to consider because cord cutting has been an issue for Disney for a while, but now that it is able to provide an alternative, it is able to sustain its very lucrative professional sports network subscription business. But all the players that are so streaming's gonna probably go basically there, and then you have other players that are that are also not pure play streaming players, but are doing it even more tangentially than Disney. Like Disney streaming makes perfect sense because it's a content company, it's a visual content media company. You have but then you have companies like Apple with Apple TV and Amazon with Prime Video. Both of which are producing interesting content, but they're pursuing streaming in a fundamentally different strategic mindset. Like neither of them are aiming to become to compete with Netflix or with Disney Plus. They're not trying to be those companies. That is just a value add on an already existing platform, especially from Amazon's perspective. So it's important to not to think of why each company is doing streaming and whether they can do it effectively, and whether the strategy that they're pursuing will make sense. A lot of people a lot of investors, in the narrative era would say well, there's no way that Prime Video or that Apple TV will ever be able to compete with Netflix. The point is that they don't want to. That's not what they're there to do.
Yes, and there's certainly several others. You mentioned Apple and Amazon and the streaming platforms they have. Those are not pure play streaming companies, as you said, but there's so many others. There's Google, who own YouTube and YouTube TV, Comcast, another content powerhouse. They have the Peacock platform out there. So it's certainly an interesting universe of streaming companies in the market right now.
Yeah, and I think it's going to be interesting to see for the companies that are media companies that are one of these sort of big network owners. That includes Disney, but it also includes CBS's route, Peacock and NBC in its lane as a way to buttress the value of the core networks that are still the only the thing that everyone still has on their TVs if they have a TV.
So I mean, all these companies are trying to get into streaming. And some of them are being successful. Disney in the past few years has been successful. We recently saw CNN try to release their own app and it failed miserably. I guess from an investor's standpoint, when you see all these companies coming out with their new streaming apps, should you pause a minute and take it with a grain of salt, so to speak?
I would say look closely at what's going on. So if a company announces a new that it's getting into streaming, first ask what their actual strategy is. Because if they're talking about going head to head with companies like Disney or Netflix that are spending $10 to $30 billion on content every year, if they think they're going to go head to head with a sort of niche player, they're doomed. But if they have a plan that will actually be able to help them monetize the existing IP or create new revenue streams at a relatively low incremental cost for things they already have, that's interesting. And However, like overall, I would say that by and large, streaming's kind of saturated and everyone knows about it. So there is not an enormous amount of excitement, I would say, like from an investing standpoint of companies trying to get into this market.
So with that being said, John, what advice would you offer to retail investors on this particular topic of streaming stocks?
I would recommend that they consider what the actual steady state of the future is likely to be. Like, look 10 years from now at or just look 5 years from now, like where you think streaming media is going to be overall. And do you think it will be more diffuse or more consolidated? And do you think that there's any chance that one of these companies that is that's still being priced, any of these companies that are priced richly on the basis of infinite or nigh infinite growth, what is the real chance of that happening? Because the long term is made up of many short terms, and if each short term fails to meet that long term growth trajectory, you're never going to get to the long term you want. So to retail investors who are in these sort of stocks, it's not just streaming, but streaming is an excellent example of it, where there has been heavy narrative where they get inordinate amounts of coverage, not only on places like CNBC as well, and on financial media and on financial websites, overcovered stocks that have become sort of totems of an industry. Rethink your exposure to those overall, because your exposure to sort of idiosyncratic risk of those companies that are, even in the best of circumstances, perhaps not going to meet their current valuation, it is difficult to see how holding a position and hoping that it will grow into an even larger valuation may be wishful thinking.
Good point there. John, one more question. Thank you so much, by the way, for coming on the show and giving your insights on this very important issue. I just have one more question, and it's the big question for today's discussion. That question is, John, during a zombie apocalypse, which fictional character would you want by your side?
Any fictional character?
Any.
Probably like Superman, I guess. Why not? He can't be bitten by human teeth. I'm going to stand behind him.
Great answer. Thank you again to John Engel for sharing your insights on streaming stocks. And thank you to everyone for listening to today's discussion. We'll be back next week for another episode of Early Bird. Have a great day.